All right, let's dive right in. Today, we're tackling one of the most critical and, frankly, most dangerous sections of the Income Tax Act for any business, Section 40A. This is a provision that can turn a tiny compliance slip-up into a massive, unexpected tax bill. We're going to break down exactly how this trap works and, more importantly, how you can steer clear of it.
So let me start with a question that might sound a little bit crazy. Is it possible for one TDS error on one single payment of 30 lakhs to land you with a tax demand of nearly 10 lakh rupees? The answer is a resounding yes. It's not just possible, it happens. But how? Well, here's the kicker. It happens because of something called a disallowance. When you miss deducting TDS, the tax department doesn't just charge you interest and a penalty. They can effectively say, you know that 30 lakh expense you paid out? As far as we're concerned, it doesn't count. It gets added right back to your profit, and boom, you're paying tax on it like it was pure income. So here's our game plan for this explainer. We are going to dismantle this disallowance trap piece by piece. We'll look at the different rules for residents versus non-residents, run the numbers to see the real financial damage, and then, most importantly, we'll talk about solutions. We'll cover how to fix these errors and set you up with a compliance checklist to make sure this never happens to you in the first place. All right, let's kick things off with our first section, really understanding the trap itself. You might be wondering, why does a rule this harsh even exist? Well, the reason might not be what you think. See, the first thing to get your head around is that Section 40A isn't really a tax. It's a compliance tool, a really, really powerful one. The government has essentially deputized every business owner, making you a critical agent in their tax collection process. And the threat of disallowance? That's the big stick they use to make sure you do your part. And this slide really highlights the critical distinction you need to make. The direct consequences of a TDS mistake, a little bit of interest, maybe a penalty, they're annoying, but they're usually manageable. It's a minor cash outflow. But that indirect consequence, the disallowance, that's where the real commercial damage is. It's not a slap on the wrist, it's a body blow to your bottom line because it creates a massive artificial tax liability. Now, here's where things get even more interesting, because the law doesn't treat every mistake the same way. There's a huge difference in how it handles payments you make to people inside India versus payments you send overseas. It really is a tale of two penalties. So let's start close to home. We're talking about the payments you make every day to your local contractors, consultants, your landlord, anyone who's a resident of India. The rule here is still tough, no doubt about it, but it's been softened a bit over the years. The magic number here is 30%. If you mess up TDS on a payment to a resident, 30% of that expense gets disallowed. Now, believe it or not, this used to be 100%, which was frankly brutal. Back in 2014, they dialed it back to 30%, trying to strike a balance. It's still a strong deterrent for sure, but it's not designed to completely wipe you out. Okay, so that's for residents. But what happens when you're sending money outside of India? Maybe to a foreign software provider or a consultant based abroad? Well, this is where the gloves come off completely. Yep, you're reading that right. For non-residents, the disallowance is a full 100%. If you pay a foreign company 1 crore and you miss the TDS, that entire 1 crore is added back to your taxable income. The logic here is pretty simple. Once that money leaves India's borders, it's incredibly difficult for the tax authorities to ever get their hands on it. So they make you, the payer, the ultimate guarantor for that tax. This table really puts it all into perspective. Just look at the differences. The quantum, 30% versus 100%. And the scope is different too. For residents, it applies to a specific list of payments like rent, contract fees, and so on. But for non-residents, it's any amount that's chargeable to tax in India. This creates totally different challenges. With residents, you might argue over the definition of work. With non-residents, you're diving into the deep, complex world of double taxation treaties to figure out if tax even applies. Okay, enough theory. Let's crunch some numbers and see what this kind of mistake actually costs in cold, hard cash. Okay, let's work through a super common scenario. You pay a resident contractor 10 lakh rupees. You forget the TDS. Instantly, 30% of that, 3 lakh rupees, is disallowed. That 3 lakhs gets added right back to your taxable income. Now, if your company is paying tax at, say, a 30% rate, that simple mistake just costs you an extra 90,000 rupees in tax, out of your pocket. And remember, if that was a non-resident contractor, the entire 10 lakhs would be disallowed, leading to a crippling 3 lakh rupee tax hit. So that all sounds pretty scary. But what if the worst happens, and you've made a mistake? Is it game over? Not necessarily. The law actually provides a few ways to fix the error and get that expense back.
Here's the first bit of good news. A disallowance isn't permanent. Think of it more as a timing issue. If an expense gets disallowed this year because of a TDS error, you can still claim it as a deduction in a future year, specifically the year you finally pay that TDS to the government. It's a pain for your cash flow right now, for sure, but you do get the benefit eventually.
But it gets even better, at least for payments made to residents. There's this ultimate safeguard, kind of like a get-out-of-jail-free card. The logic is simple. If the person you paid has already declared that income and paid their taxes on it, why should you, the payer, be penalized? That's where something called Form 26A comes into play. Now, using this safeguard does require a bit of teamwork with your vendor. First, they have to file their tax return and include your payment in their income. And critically, they have to pay whatever tax is due on that income. Once they've done all that, you can get a certificate from a CA in Form 26A and file it online. And just like that, you have a complete defense against that 30% disallowance.
Okay, so fixing mistakes is great, but you know what's even better? Not making them in the first place. This is where we shift from being reactive to being proactive. And your annual tax audit is your first and most important line of defense. You see, your tax auditor is legally required to report these defaults in their audit report, called Form 3CD, and it's incredibly specific. Clause 21 IAA is where they report non-deduction for non-residents, which triggers that 100% disallowance. Right next to it is the clause for residents. Even just being late to deposit the TDS gets flagged. The key takeaway here? There's literally nowhere to hide. These errors will be found and documented. So, how do you stay ahead of the game? Here's a simple but incredibly effective 5-point checklist. 1. Keep your vendor master files spotless. 2. Have a maker-checker system. No payment goes out without a second pair of eyes on the TDS. 3. Reconcile your books every single month. 4. Do a big final review before you file your tax return. And 5. Always keep your paperwork in order. Build that defense file before you even need it. And that really brings us to the bottom line. Section 40A completely changes the game. It turns TDS from just another compliance task into a major business risk. So you have to ask yourself, is your current TDS process a safeguard protecting your profits, or is it a ticking time bomb waiting to go off? The answer to that question could very well determine the financial health of your business.